They don't want you to know. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the political elites are in full denial mode as they don't want you to know we're headed into a major recession. And yet we've covered this in detail and shown you how the leading indicators are suggesting that there's something seriously wrong with the U.S. and global economy. And now we're going to take a look at one of our favorite political elites and see how she's spinning the recent news. And I'm going to show you in the charts just how wrong she is and how likely we're seeing a recession here within months. Let's over to Bloomberg, where we picked today's story up with the headline: Yellen notes inflation problem, but still sees soft landing path. Now, again, I want you to understand they're never going to come out and tell you, hey, we're going to have a hard landing. Hey, we think there's a financial crisis. They're going to deny this, and particularly Janet Yellen. Remember, she's a Treasury Secretary, former Fed chair, and back when she was just a regional Fed president, the housing market in her district was collapsing, and she kept saying, hey, we don't see there's a problem here, so don't be surprised by what she's saying. Wait till you see the data and just how wrong she is. Yellen's comments come after data on Friday showed the Federal Reserve's preferred inflation gauges unexpectedly accelerated in January, and consumer spending surged after a year-end slump, adding pressure on policymakers to keep ratcheting up interest rates. So here again, we're looking at lagging data, which we'll look at in a moment, and say, wow, the consumer is really strong here. But as we've kind of talked about on the show, when you start adjusting some of these numbers for inflation, well, they're nowhere near as strong as they need to be. But now let's take a look at this data and see where we go here, because you're going to find out that Yellen's got this, like I said, completely wrong. So what came out on Friday was a PCE, or Personal Consumption Expenditures Price Index. Notably, let's look at this year-over-year rate of change, up from 5.3 to 5.4. The core excludes food and energy, up from 4.6 to 4.7. So from a headline perspective, you get the idea that, hey, inflation is supposed to be cooling off here. It's not. The Fed needs to do more because for some magical reason, moving the federal funds rate up lowers inflation. And really, as we can see, it doesn't really have much of an impact. But here's the other side of the data, because what the Fed wants, what policymakers want, is you to spend less, slow the economy down. When we see the rest of the data, they get an indication the economy here is red hot. Here we know personal income surged higher, 0.6% in January. Personal spending, look at this, went from minus 0.1% to 1.8%. I mean, you get the impression here, consumers, have animal spirits out there. They're out spending real or inflation-adjusted personal consumption up 1.1%. Now, for those of you who do not know the difference between the PCE and the CPI sources data from consumers, the PCE sources from businesses. So you get a kind of different effect because they track some different things. But notably, if we were to put a chart up and show the two, they're relatively similar. Again, the Fed just prefers this from the business perspective, even though it really doesn't matter. We're nowhere near the Fed's target, which suggests, of course, in their meeting coming kind of late March, that based on the data at the moment, they would likely further raise rates. But again, we're going to make the case why we don't need to see that, why the data is suggesting the economy is headed into a bad place. And Yellen, of course, is just doing what she always does, is tell people, don't worry, go out and spend, because if you don't, the economy is going to crash. Now let's take a look at the personal consumption expenditures. Now we got the chain type price index. This matches the data we saw. And the reason I'm showing you this chart is because when I first pulled this chart up, it looked eerily similar to another chart. And let's overlay the West Texas Intermediate crude oil, because we've been making the case in the show here that crude oil is a leading indicator. In fact, this weekend I went on to Jeff Snyder's show at Eurodollar University. We talked about this again, so check that out when it releases. I don't know what day. But I want to go back to this chart and show you that the Fed, and Yellen here in particular, is saying, look, we've got more work to do. And of course, we're going to hear that from the Fed speakers. But the energy market is telling you exactly the opposite. Is it just this lagging data from the government? And maybe it's a seasonal adjustment issue. Who knows? But that data is going to come down. And here we can note the eerie similarities between these charts, where we can see that crude oil often leads personal consumption expenditures by a wide margin. So here you can see, and this is a great example, going into the dot-com bubble, crude oil prices were crashing down on a year-over-year rate of change, and that led personal consumption expenditures. Again, you think about what businesses are impacted by energy costs. You see it here during the great financial crisis, and now look, you see this massive decline in crude oil on a year-over-year rate of change. And what do you think is going to happen with PCE? Well, it's going to come crashing down as well. Inflation continues to be a problem, Yellen said, of course, because the number isn't dropping as fast as we want. The data we've seen suggests it's not yet under control, but it's come down. Well, maybe it is under control. Maybe if you didn't use lagging data, it would be there. As Yellen signaled, her outlook didn't change after the latest price reading, especially given the month-to-month volatility. In fact, that inflation expectations, now this is interesting, remain well contained. Now, we love inflation expectations on the show, as you know, because it's based on what usually the consumer is seeing. But now let's look at two charts. I want to show you how the market looks at inflation going forward, then we'll look at how the consumer is looking at it, and what you're going to see is both of them are consistent with their view that inflation's coming down, whereas all these political elites, the Fed, you have Janet Yellen, and everyone else around the world is saying, no, inflation's a problem. We need to keep tightening rates so we can validate and verify that what we do as central bankers work, even though it doesn't. Here we can see the five-year forward inflation rate expectations. This is the stock market, or the bond market's way of we'll just say the market's way of looking at 5-year forward inflation. And notably, I overlaid U.S. regular all formations gas price, which really is pretty much the best barometer of inflation expectations, because when gas prices are coming down, well, we know the market says, yes, inflation's coming down. Here we see gas prices coming down. And you'll notice that the five-year isn't surging higher. It's rolling over, and it's very moderate, looking like it's headed lower, and not what, of course, the political elites are saying. Now let's look at one of my favorite gauges. This from the consumer. We have the University of Michigan inflation expectations, this in blue. Again, we're overlaying all formations gas prices because, again, it's the best proxy for inflation. Gas feeds into so much of the consumer prices that we know where it goes, inflation falls. And here we can see on a year-over-year rate of change, gas prices are zero. They're going to go negative through the summer. And what do you see? Inflation expectations coming down. We can note that typically gas prices lead inflation expectations. She stuck to her view that a soft landing continued to be possible due to the strength of the labor market. So again, you see this denial that, look, we need to engineer a soft landing here, because if we don't, once again, our credibility as policymakers is going to be put into question, and we're going to have to figure out somebody else to blame so we can get out of this. But notably, they want you to believe a soft landing is coming, because if you start to believe otherwise, and you cut your spending as a result, which is what people tend to do, well, then it will manifest itself into a hard landing. But what I'm trying to suggest to you is we're headed there anyways. The soft landing continued to be possible due to the strength of the labor market. We'll address that in a moment. And the absence of kind of stresses for household or the financial sector that have preceded downturns, such as perhaps the fact that household savings rates are at multi-decade lows. But no, we don't look at that. I do believe that that's possible, and it's what I hope the economy will experience. And I don't see any clear signs at this point that the possibility is becoming more remote. And of course, we know, and as Jeff Snyder and I talked about on his show, why doesn't the Fed, why don't these policymakers look at the energy market? Because it's screaming out loud that, hey, bad things are coming if you could only open your eyes and see. Recent indicators have shown a strong start for the economy in 2023 with job growth, retail sales. Again, they're going to harp on retail sales. I'm going to bust that balloon for you here in a moment. And service sector activity, which we've already talked about, falls. The manufacturing sector down, but that did pop in January. The resilient spending and stubborn inflation suggest the Fed's path to taming prices and demand will be bumpier and longer than the data for late 2022 has previously indicated. And of course, as you know, we're going to debunk this whole thing. Let's start with that retail sales data, because it indeed is coming down, and here's the evidence. On this chart, we have advanced retail sales in blue against crude oil prices in red, and you can see a beautiful relationship here. Crude oil prices leading retail sales lower. It's done that for the most part. You see out throughout the data series, there's brief periods here during going into the great financial crisis where it didn't, but overall, you see crude is a fantastic leading indicator. So Yellen, you got that one wrong. How about the labor market? She says strong. Well, we know when retail sales comes down, which is going to because crude oil prices are coming down, that you can see these two are almost a mirror of each other. And what that says is retail sales drop. Well, they're going to need fewer employees, and you're going to see the 4-week moving average of claims head higher. And yet they claim the resilient consumer spending paired with the exceptional strength of the labor market will make it more difficult to the Fed to get to this 2% goal, according to Yellen. Well, I don't think so. Here we can see the consumer price index against the U.S. regular all formations gas price, both on a year-over-year rate of change. As we pointed out, and many times you see a 0% here on the right for gasoline. Over here you see 2.5%, which is the typical rate of the CPI. This is going negative, my friends. By the summer, you can see this rate of change will go negative. That means the CPI is likely to post deflation, meaning Yellen has got it wrong. But notably, I want you to see where these comments were coming from, because she wasn't alone. She was hanging out with a lot of other political elites. Her remarks come on the back of 2 days of meetings from the group of 20 finance ministers and central bank chiefs in Bengaluru, formerly known as Bangalore, where she sounded more positive about the state of the world economy than a few months ago. And for good reason. She has no choice, because I believe that they know the truth is coming, and they don't want you to know, because if you cut your spending now, the economy will see a recession. But if the consumer can go out and spend money, there is a possibility, perhaps remote, that we could see the soft landing. And there's one data series I think they're hanging on to that might show some good news. Well, we'll see how long it holds. But it's real, or inflation-adjusted disposable personal income, for the first time in a very long time, is now back in positive territory. But notably, this major deceleration, this negativity here due to the consumer price index showing that consumers were not keeping up with inflation, is just another nail in the coffin of why I think we're headed into a recession here in the next couple of months. That third, fourth quarter bit, I think it's off the table. I think second quarter, it's going to become clear, even though the government data, I'll predict will show it with a lag, probably somewhere around the third quarter. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.